473,401. This is from the COMEX website. These are more up to date. They do not have a 24-hour lag. So you can see here the number says 2,537 contracts closed. However, it's not that much. This is a misleading number because the actual number is 1,006. How did I get to 1,006? I'll tell you why.
Well, I'll tell you why.
Because there was 1,531 gold warrant deliveries yesterday in October gold. So that means that open interest closed out 1,531 because every time there's a delivery, a contract closes. Every time something happens, an angel gets its wings, or whatever the saying is. So if 1,531 contracts closed, but they didn't really close, they got delivered. So how many shorts actually bought back their contracts rather than delivering? You have 2537 minus 1531, and that is 1,006. On a day when gold is down 6-7% or whatever it was, you only have 1,006 contracts closed. Plus, you have huge buying in the October 25 contract. You have a rise of 759 contracts here with 1531 deliveries. So net buys would be 1531 plus 759. The first strange thing that I saw from yesterday and 2 days ago, and actually this whole past week, is the borrow fee for SLV specifically. This does not apply to PSLV. It doesn't apply to the other gold or silver ETFs. This is just a SLV specific thing. SLV is the silver ETF with the biggest liquidity, with the largest liquidity. You see here that the borrow fee for SLV went above 19%, almost to 20%, which means there was a lot of demand to short this ETF. Some people apparently knew that there was going to be some kind of sell-off, whether they are silver market insiders or hedgers or banks playing unfair games. I don't know who they were, but this doesn't always portend a sell-off. But we saw here in early February, the borrow fee went up to about 16%. That didn't really lead to much sell-off in February 2025, though this one apparently did. So sometimes they can be wrong, sometimes they could be right. But this big borrow fee spike in SLV did predict that something might happen, and apparently it did. Open interest in gold. This is important, and we're going to go back to this chart in a few slides just to emphasize something else about it that's very interesting, and that is open interest, first of all, is going nowhere. It's not going up. It's not going down. It's about 476,000 contracts. It's because this is on a one-day lag, but you see here a huge red candle down. That was the sell-off in gold yesterday, and still open interest hasn't gone anywhere, and it's still pretty low, 476,000, which means that contracts did not close out. Shorts did not close their positions, not at all. So they're still holding on to their short positions, and why is that? We'll go into in a minute.
Turning to the gold futures side, we note that open interest for the CME Group COMEX gold contracts remained elevated, even on a sharp price drop. New data show open interest hovering around 500,000 contracts rather than collapsing. On a day when prices plunged, one might expect aggressive short covering, but that did not happen. The shorts appear trapped, still holding positions opened at higher levels. This makes the market tightly wound for future moves.
473,401. This is from the COMEX website. These are more up to date. They do not have a 24-hour lag. So you can see here the number says 2,537 contracts closed. However, it's not that much. This is a misleading number because the actual number is 1,006. How did I get to 1,006? I'll tell you why.
Well, I'll tell you why.
Because there was 1,531 gold warrant deliveries yesterday in October gold. So that means that open interest closed out 1,531 because every time there's a delivery, a contract closes. Every time something happens, an angel gets its wings, or whatever the saying is. So if 1,531 contracts closed, but they didn't really close, they got delivered. So how many shorts actually bought back their contracts rather than delivering? You have 2537 minus 1531, and that is 1,006. On a day when gold is down 6-7% or whatever it was, you only have 1,006 contracts closed. Plus, you have huge buying in the October 25 contract. You have a rise of 759 contracts here with 1531 deliveries. So net buys would be 1531 plus 759, and that is like 2,300 contracts, something close to that. A net buying of 2,300 over that contracts in spot gold when gold is down 6-7%. Also, you have 395 contracts bought net in November, which goes to delivery in, I think, 4 or 5 business days. So somebody was buying either spot gold or very close to spot gold yesterday. Yes, the futures, the December 2025 active futures fell about 4,000 contracts, which is not a big number to fall, but it did fall.
If shorts held firm, who filled the gaps when gold sold off? The answer, other market participants jumped in to buy the dip. Evidence points to significant buying activity in near-term delivery contracts, while open interest barely budged. As traders stepped in to scoop up contracts, the typical short covering didn't materialize, suggesting a shift in market structure and sentiment. The indication, an underlying base of buyers ready to act when price turns, while the traditional spec short pool remains underwater.
But we can see here a more detailed depiction of what happened yesterday. So we have 3 things. I wrote here: high, not high, and very high.
Are you high? What? No, I'm not high. What?
You are high as a kite.
I'm not high. Let's go.
Because I got high.
What is not high? That is the current open interest of 476,000. We saw this on the previous slide, but this is a more zoom out so you can see back to 2020. We have here a price high and then a sell-off over here. This should have led to a huge sell-off in open interest, but it did not. Open interest barely moved, just over 1,000 contracts, but we did have very high trading volume. So what does it tell you that we had high trading volume, but contracts did not close out? So we did have a lot of sellers, that's where the volume comes from, but we also had a lot of buyers who were not the short sellers, because if the short sellers buy back their positions, those contracts get canceled out and they get erased from open interest. That's not what we saw. We saw people other than the short sellers buying the contracts that the longs were selling in this sell-off. Now, why is it that the short sellers did not buy back their contracts on this 6-7% plunge in gold? I'll show you from this chart that we saw earlier. This is the beginning of the major rally in 2025 from August after this 4-month consolidation. This was the bottom around here and the bottom on open interest of about 435 maybe thousand contracts. I'm just eyeballing it, estimating. And this is when open interest really started to climb as the price climbed. But remember, they opened their contracts from between, let's say, 3,300 or so, or 3,350 to about what the maximum in open interest here is about 530,000. So in this area over here where my cursor is, where my arrow is, this is where they opened all of those contracts between 3,350 and it looks like about 3,700 or so.
Beyond futures, physical delivery metrics and ETF behavior reinforce the narrative of structural change. Deliveries in the gold complex have surged, with some days exceeding thousands of contracts. This suggests a strong physical demand component. Meanwhile, the largest gold ETF, GLD, registered 0 outflows on a large sell-off day, a clear sign that dip buyers were standing ready inside the fund. These dynamics hint at both strong investor demand and a constrained short base.
We are way above that right now, which means all of these shorts, which opened up over here, you can see the rise in open interest from about mid-August to late September of this year. All of these contracts were open in this price range, which means they are all underwater despite this sell-off, which is why they did not buy back their contracts, because they're still underwater.
Why couldn't she be the other kind of mermaid, with the fish part on top and the lady part on the bottom?
So who was buying instead? Other speculators who are buying this dip, which means there's a lot of dip buying in the New York COMEX futures gold right now. The other thing I wanted to clarify about this chart is that this is March 2022. Remember nickel Armageddon, when the nickel futures price started going crazy and there was a short squeeze because some nickel mine had a whole bunch of shorts, and then all of the London Metal Exchange started to tip over and they had to get bailed out. Well, that was concurrent with gold having about a 650,000 open interest level over here, which is very high. You can see this is the highest it's been in the last 5 years, and that did correspond with a local high, with a major high in the gold price in March 7th, I think it was, 2022, of about 2,000, just under 2,000, about 2,000, whatever it was. And then the gold price fell to about 1,800 by the end of 2022. That was a that was a serious consolidation. And you saw open interest here fall from about 650,000 to here of about, what is that, 450,000 or a little bit less, something around there. So let's say about 200,000 contracts were covered, and short sellers bought back their positions, and those contracts were erased. We're nowhere near those numbers now. So there's still a lot of room in this rally, and as we said before, this volume is very high, and it wasn't the short sellers buying back their positions, so it was other speculators taking their place and taking advantage of this price drop. We can see something else that is going on in gold, and that is a lot of deliveries keep happening, and they are every day. That's sustained over 1,000 deliveries a day, over 1,500 even.
Returning to silver, the earlier spike in SLV borrow costs reveals deeper tensions. With limited shares available to borrow, short sellers face elevated costs. In some cases, lenders demand double-digit annualized fees, illustrating tighter supply and higher stress. When physical liquidity of silver is strained, ETFs like SLV can become pressure points, amplifying moves both on the physical and paper side. Investors should watch these borrow fee levels as a risk indicator.
Some days 2,000, some days as high as 4,000. Yesterday was 2,442 deliveries. We were up to 57,517 deliveries for October 2025, and that is so far the third highest month ever, and it looks on track to become the second highest month ever. There's a chance that it could become the highest delivery month ever. We'll see that on this next chart over here. This is where we are, 5.75 million tons of gold warrant worth delivered. That has exceeded the May 2020 high of about 55,000. We're now at 57,000 contracts. This is the all-time high over here a few months ago. In early 2025, I think it was 7.6 million ounces or 76,000 contracts. So I think we're going to break this over here. I'm not sure what month that is. It was this year. But looks like we're going to break it. And October isn't even a front month. It's not even an active delivery month. But the next active delivery month is December. November is not active either. But for October, this is definitely a record for October. And it's almost an all-time record. Third highest delivery month. There's huge deliveries going on in COMEX right now.
I.C.Wiener.
Delivery for, icy wiener. Oh, crud.
What about GLD? Here's another indication that there was a lot of dip buying also in ETF investors, because normally when GLD falls, and it fell, I think it was the fourth worst day for GLD. It was either the third or the fourth worst day for the GLD price, GLD Gold ETF, the Spider shares. Fourth worst day ever. And on a day like that, you would expect that the ETF would lose gold tonnage or gold ounces, because that's what happens in order to keep the GLD price in line with the gold price, the gold futures price. If the price goes down, there's a big sell-off. Usually they have to take ounces out of the fund in order to keep the share float aligned with the price.
So, what should we take away? First, precious metals markets are underpinned by strong flows, not just speculative froth. Second, when open interest remains high and shorts don't clear even during sharp moves, the stage is set for a bigger move in either direction. Third, monitoring borrow fees in silver and delivery metrics in gold gives a clearer read on underlying stress and demand. As global uncertainty mounts and central bank behavior shifts, these markets could pivot sharply. Emotional discipline remains key, stacking steadily, avoiding over-leverage, and keeping one eye on both the paper and physical side.
This time, there was no change in GLD holdings at all. 0 million ounces or just 0 ounces were moved from the fund yesterday despite the humongous sell-off. So what does that tell me? It tells me that there was demand for the ETF yesterday as dip buyers came in and took positions, saving GLD from having to shed gold ounces in order to keep it in line with the gold price. Because once it sheds gold ounces, there are fewer GLD shares available. The shares supply gets constricted and it stays in line with the gold futures price. That's the idea how these ETFs work. So what I'm saying is there was dip buying in gold futures. There was major dip buying in GLD ETF. So I think, I'm not saying that this sell-off is done necessarily, but there were a lot of buyers that came to take advantage of this sell-off and to get into gold investment vehicles and gold futures at a much lower price. The last chart that I'm going to show is it's not just New York that is stockpiling gold, that has a near record amount of gold supply. It's also China. You can see here since 2024, the amount of physical gold in China, and you can either trust this chart or not trust it. I'm just showing it to you. I don't know what to really make of numbers and statistics in China. They could all be lies for all I know, but for what it's worth, it says here that in 2025, the gold supply, physical gold warrant supply in China, in Shanghai, I think this is at an all-time high, 84.606 tons, which is 2.7 million ounces. That's still about 10%, maybe a little bit more, like 12% of what's in New York. So this is still a pretty small stockpile of gold, but it is going up. And so we'll close this video out with another reminder. Keep your emotions balanced. Don't get too positive. Don't get too negative, because that's how they knock you off. If you get too positive, you get too greedy, you start investing in leveraged funds, and then you can get really schmeiced and destroyed. That is not what we want. We want to keep stacking steadily and use leverage only very sparingly, like a dessert or wasabi on a sushi. And one last reminder, gold and silver are going to have periodic sell-offs until the Fed engages in its final printing round. That is coming, and only at that time will gold and silver just go up day after day after day until the dollar is dead.